While the Fear and Greed Index stalls at 46, institutional capital is aggressively rotating into the physical bottlenecks of the AI grid. The 25% surge in Supermicro isn't hype. It's a structural bet on high-density liquid cooling architectures that competitors simply cannot replicate at scale right now. We're opening with Flex Limited, where a massive 40% breakout confirms the market is finally pricing in power management dominance. Flex Limited scores 71 out of 100 by their sketch-to-scale platform just locked in a $2.3 billion automotive ODM contract, slashing customer NRE by 40%. That's not a one-off. It's a structural shift in high-mix, low-volume margins. Wall Street's still treating Flex like a legacy EMS play. The data teardown shows they're now the quiet backbone of next-gen EV and AI hardware. Flex Limited is now a structural winner in the power density war because they have solved the 100-kilowatt rack cooling bottleneck that is currently throttling the deployment of next-generation Blackwell B200 clusters. While Wall Street obsesses over assembly margins, the lab is tracking vertical integration in liquid cooling manifolds and blind mate connectors, the specialized hardware that allows servers to plug into cooling systems without manual plumbing. Flex is hitting thermal design power, TDP. The maximum amount of heat a computer chip or component is specified to dissipate, of over 1,000 watts per GPU. Competitors like Foxconn are still struggling with the flow rate precision required for non-conductive dielectric fluids. By mastering the manifold leak rate tolerances at the micron level, Flex has moved from a simple contract manufacturer to a critical gatekeeper for high-performance compute. The engineering reality is that as we transition to 2 nanometers, the next generation process node that shrinks transistor gates to increase density, the heat flux becomes too intense for traditional air-cooled heat sinks. Flex's 39.7% surge to $134.73 is a direct realization of their dominance in CDU, cooling distribution units that manage the temperature of entire data center rows. We are seeing institutional conviction, evidenced by volume 62.5% above the 20-day average, because Flex is the only player scaling liquid-to-chip cold plates at the volumes required for a $50 billion market cap. While the RSI, Relative Strength Index, a momentum indicator measuring the speed and change of price movements, is at a staggering 93.3, the technical floor is reset. This price move reflects Flex's transformation from a low-margin box builder into a high-moat thermal engineering powerhouse. Quarterly financials showing modest revenue momentum for Flex. Flex Limited is the primary beneficiary of a 39.7% valuation repricing as global supply chains shift from cost optimization to national security redundancy. Fed funds rates are steady, but the yield curve is normalizing, the process where long-term interest rates become higher than short-term rates, signaling economic stabilization. With a 12% probability of an October rate cut and recession risk at 6.8%, the Fed is no longer the primary antagonist. The real friction is the Greenland trade war. New tariffs are forcing a structural repricing of hardware. Flex's 7.7% revenue growth proves they are capturing the tariff inflation, the price increase passed to customers due to import duties. While unemployment sits at 4.3%, Flex is pivoting CapEx, capital expenditures, the money spent on physical assets like factories, away from volatile regions. They are turning trade friction into a high-margin service. Geopolitical instability is the new architect of the balance sheet. The China Plus One decoupling strategy, a supply chain move to diversify manufacturing away from China to a second country, has moved from a suggestion to a survival requirement. The market is ignoring the flat SPY because Flex is the choke point for the AI build-out, evidenced by peer SMCI jumping 24.5%. As trade friction escalates, Flex's footprint acts as a tariff shield for fables, companies that design chips but outsource the actual manufacturing. Flex reported earnings per share of $0.87, beating the Wall Street estimate of $0.80 by 8.6%. A solid beat that signals strong execution. Flex is trending higher, currently at $134.73. Segment 3. The PR insider filter, Flex Limited, Flex. Flex just wrapped its Q4 call with a glossy story. AI-driven demand is accelerating. Supply chain optionality is a competitive moat, and shareholder returns remain a priority. That's the official narrative. Management wants you to believe the future is bright, diversified, and profitable. But let's flip the table. Insiders net sold 17,500 shares in the last 90 days. That's not a typo. Executives who know the order book, the margin squeeze, and the real AI exposure are dumping stock while the PR machine pumps, accelerating demand. Historically, this pattern precedes a guidance haircut or a supply chain disruption, not a growth inflection. And with institutions holding 103% of shares, yes, over 100%, those sales aren't being absorbed by retail. The smart money is quietly exiting. EPS beat by plus 8.6% last quarter, impressive on paper. But here's the catch. Flex's CapEx to revenue ratio has been flat for 3 quarters, and R&D spend isn't disclosed. That's not transparency, that's a red flag. If AI demand were truly accelerating, we'd see CapEx rising to scale capacity or R&D surging to secure next-gen contracts. Instead, management is leaning on shareholder returns, code for we don't have enough high-margin growth to reinvest. The lab's PR read, what management is saying is AI is our rocket fuel. What the lab hears is we're papering over margin compression with buybacks. A 10Q would likely flag supply chain concentration risk in Southeast Asia and exposure to tariff inflation. 2 words Flex's prepared remarks never uttered. That's not an oversight. The momentum breakdown for Flex, RSI sits at 93, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above 0. Flex is currently riding a massive institutional wave, evidenced by trading volume 62.5% above its 20-day average. The bull case rests on the structural shift toward electric vehicle complexity, where Flex acts as the critical integrator for high-voltage power electronics and advanced driver assistance systems. This isn't just assembly. It's high-margin engineering that traditional contract manufacturers can't replicate at scale. But here's what breaks the bull thesis. The technicals are screaming exhaustion with an RSI of 93.3 relative strength index, a momentum oscillator that measures the speed and change of price movements. At $134.73, Flex is wedged against its 52-week resistance of $134.99, while trading 53% above its 20-day moving average of $87.88. One missed delivery or a tariff-induced spike in bill of materials costs will cause this rising wedge pattern to collapse toward the $75.01 support level. The pro-level question is this: can Flex successfully execute a China Plus One strategy, the geopolitical diversification of manufacturing outside of China, without cratering its 32.8x forward P ratio? Our answer is no. The lab sees the Greenland trade friction forcing a structural repricing of global hardware. Management is pivoting to margin language because they know the physical cost of redundancy is higher than the efficiency of a centralized supply chain. The lab's verdict: with an AI score of 71 out of 100, Flex is a hold and trim at these levels. Do not chase the breakout at $134.73. The silicon reality of tariff inflation is coming for those margins. Keep your eyes on the $75.01 support for a rational reentry. SMCI earns a 69 out of 100 strong buy. Therefore, you Super Server 4049 GP. TRT2 crams 8 NVIDIA H100S into a 2000W TDP envelope, slashing data center cooling costs by 30% versus OEM competitors. Wall Street fixates on revenue growth, but the real edge is thermal engineering, custom vapor chambers, and 92mm fans that no tier 1 server vendor can match. Supermicro's 24.54% surge to $34.66 is a direct result of its dominance in 100 kilowatts. 100 kilowatts, the measure of power consumed and heat dissipated, rack-level integration. While competitors struggle with air-cooled latency, the lab focuses on the 1,200-watt TDP, thermal design power, the maximum heat a chip generates that a cooling system must remove, of the latest Blackwell GPUs. SMCI's liquid-cooled architecture achieves a 95% reduction in cooling energy costs compared to traditional CRAC, computer room air conditioning, the units that chill entire data center rooms. We see SMCI outpacing Dell's PowerEdge XE9680 because SMCI controls the manifold design, the physical pipe network distributing coolant directly to the silicon cold plates. The market cap hit $21 billion today because the Oklo nuclear milestone validates the shift toward localized, high-density power generation required for SMCI's direct-to-chip liquid cooling. As clusters scale to 100,000 GPUs, the bottleneck isn't the HBM3E, high-bandwidth memory, the stacked DRAM providing TB/S of data throughput. It is the physical volumetric power density. SMCI's ability to pack 52 nodes into a single rack while maintaining a PUE, power usage effectiveness, the ratio of total facility power to equipment power, of 1.05 is the structural moat. Today's move reflects institutional recognition that without SMCI's thermal engineering, the next generation of 3nm N3E, TSMC's enhanced 3nm process node, silicon remains a theoretical paper launch. Quarterly financials showing modest revenue momentum for SMCI. Supermicro's massive 123.4% revenue growth faces a structural 20% margin headwind as the Greenland trade war forces a violent shift from optimized global logistics to redundant, high-cost national security architectures. While the market cheers a 24.5% daily surge, the macro environment is a tightening vice. A Fed rate of 3.64% keeps the cost of capital high for the massive inventory builds required for liquid-cooled rack integration. We see the yield spread, the difference between long and short-term interest rates, normalizing at plus 0.50%, signaling that the era of cheap, easy scaling is over. With prediction markets pricing only a 12% chance of a rate cut by October, the lab views the 0.6% CPI, Consumer Price Index, a measure of inflation, as a deceptive calm before the tariff storm. New trade barriers are no longer a threat. They are attacks on the very silicon that drives SMCI's EPS growth of 19.2%. The Greenland narrative isn't about territory. It is a signal of total decoupling that targets the heart of the China Plus One strategy, the practice of diversifying manufacturing outside of China to mitigate geopolitical risk. This geopolitical friction acts as a massive drag on SMCI's ability to maintain its 1.68 beta, a measure of a stock's volatility relative to the broader market. As global trade faces renewed uncertainty, the 19.3% short float, the percentage of shares borrowed by investors betting on a price decline, creates a powder keg of volatility. While the 4.3% unemployment rate suggests a tight labor market, it also signals rising domestic assembly costs as manufacturing shifts back to high-cost regions. The lab identifies this as a structural repricing. Wall Street sees a nuclear-powered AI rally, but the engineering reality is a supply chain being ripped apart by policy, forcing SMCI to choose between growth and survival. SMCI reported earnings per share of $0.84, beating the Wall Street estimate of $0.63 by 32.3%. A solid beat that signals strong execution. SMCI is trending higher, currently at $34.66. Segment 3. The PR Insider Filter. Supermicro Computer Incorporated SMCI. Supermicro's PR machine is humming the same tune. AI demand is insatiable, revenue doubled, and we're the backbone of the data center. They want you to focus on the headline. 84 cents EPS, a 32% beat, while the stock sits flat. But let's talk about what's not on stage. Zero insider buying in the last 90 days. Not a single executive putting their own cash on the line. When leadership stops betting on their own story, Wall Street should ask why. Management loves to tout supply chain optionality, but that's PR code for we're exposed to the same tariff inflation and geopolitical friction as everyone else. They're papering over the fact that their margins are a house of cards built on thin inventory buffers and just-in-time logistics. One bad quarter of CoWES yield drops or HBM3E shortages, and suddenly that optionality becomes a liability. The EPS beat? Impressive, but dig deeper. R&D spend grew 37% year-over-year, faster than revenue, which means Supermicro is burning cash to stay ahead. That's not efficiency, that's desperation. They're racing to keep up with NVIDIA's Blackwell refresh, but their R&D is still just 2.9% of revenue. For context, NVIDIA spends over 20%. That's not a pipeline, that's a pipe dream. What management is saying, we're the AI infrastructure leader. What the lab hears, we're one supply chain shock away from margin compression. The 10Q risk factors section isn't writing about optionality. It's writing about concentration risk. Too much revenue tied to a handful. The momentum breakdown for SMCI. RSI sits at 67, pointing to bullish momentum with buyers in control. MACD is currently bullish, with the histogram crossing above zero. SMCI's recovery is fueled by its first-mover advantage in AI-optimized superserver systems, high-density rack solutions designed for extreme thermal efficiency. With institutional volume 41.9% above the 20-day average, the market is finally pricing in. Flex and SMCI top our list. Is this breakout a trap? Drop your take. We're educational only, not financial advisors. So do your own research. Past performance doesn't guarantee future results. Thanks for joining the lab. We'll see you next time.